I can guarantee that I will make you a funded trader. Now, not many people in the trading space can say that, but I've been running my mentorship now, and when people follow what I say and are consistent, they don't break their rules, they have good risk management, and they stay disciplined, they will become funded and they will be on the way to getting payouts, and they will get payouts in the future. Now, in this video, I'm going to be showing you exactly what you need to do to start heading in the right direction to become extremely profitable, okay? This is going to be a very raw video, unedited, of just me talking about exactly what you need to do from a presentation that I have previously made. Now, let's start at the start of this video. If you're consistently losing trades pointlessly, then you need to watch, and you need to watch this video to the end, and you need to not only watch this video, you need to make sure that you're taking notes. Don't just watch videos like this like a Netflix series, because then how are you going to learn? Over 90% of traders, it's actually a lot higher, around over 95% of traders consistently lose money in the markets. But why is that? Why do most traders lose money? Why am I making loads of money, and why are you most likely losing loads of money? There must be a reason for it. Because most traders are following the same patterns. Your average trader is having the retail approach, they're drawing a trend line on the chart, or even they're trading ICT concepts, but they're just doing it completely wrong. We're using data, a proven track record of a simple strategy that makes loads of money. It's simple. We don't buy with a crowd, okay? The way that I use fair value gaps, for example, which I'll talk about later in the video, I don't wait for a fair value gap to be tapped into and then respected going in one direction. I do the complete opposite. I wait for fair value gaps to be disrespected, and guess what? I don't use a stop loss. Now you might be thinking, what do you mean you don't use a stop loss? Wait till the end of the video and I will explain it. It will all make sense. We wait for inversion fair value gaps and we use liquidity properly. Of course, do not trade with emotion. Most people trade with emotion. Now you might be wondering as well, why do people trade with emotion? It's easy to say people are emotional. Of course, everybody's emotional. If you take a loss, you're going to want to make it and get it back. That is the natural instinct. That's completely normal. But you can't do that. You need it logical and data driven. Why do people have emotional entries? Now, the main reason, in my opinion, and what I have found from my mentorship, is you need to be confident with your strategy. It's okay saying be disciplined and follow rules and follow this certain entry model. If you're not confident in it working and you've not seen people do it in the past, then why would you be confident, and why would you wait for entries when that entry arrives you don't think it's going to win? So of course you're most likely going to be emotional then. And of course the win rate factor. This strategy has over an 80% win rate if you are trading the higher quality setups. Of course you can take more consistent entries in the market with a bit of a lower win rate, but if you're entering the high quality setups, it's over an 80% win rate, which is crazy. And I'm going to tell you exactly when I've got into the market, and that's exactly what this video is about. Now, a tiny bit of background for me. I've been trading for over 4 years. I've tried all the strategies before. I posted a picture on my Instagram story yesterday of what my charts used to look like. I had the MACD lines, I had the black chart with 100 indicators. It's just not how to trade. Here's some of my students' results. I've one-on-one taught over 1,000 people in my private community. I have over 38,000 members inside of my Discord group. I live stream myself trading for the past 2 years. And let's jump straight into the full inversion edge guide, okay? Inversion fair value gaps and liquidity sweeps. You just need to do it the right way. Let's start from the basics. What is a candle? Now you might be wondering, Louis, why on earth are we looking at this? This is extremely important because I don't use a stop loss. So understanding 100% how a candle works, even though you might think how it works, is extremely relevant to this video. So obviously this is a bullish candle, green. It doesn't necessarily matter what color the candles is. In my opinion, the first thing that you want to do when you load up TradingView or load up your charts is not use green and red, or most importantly, do not use red as a bearish candle. bearish simply means a candle going down. The reason for this is if you see red in the market, you're going to automatically think that it is bad, okay? But when we have a down candle, you can make just as much money shorting the market as you can longing the market, okay? So change your red candle, I have mine set to black. But what is a bullish candle? So it's four main compartments. You have the open of a candle. If the candle is bullish, the open will always be at the bottom. Then you have the close of the candle. So this is the open. If it's a bullish candle, you always have the open. So let's say that we're looking at a 1 minute chart, for example. If we're looking at a 1 minute chart, then each candle in the market is going to represent 1 minute. If you're looking at a daily chart, each candle on the daily time frame will represent 1 minute. At the start of every minute, you'll get an open. So you'll see this line of the chart and the chart will start and the candle will start forming. Let's say that price action comes up to this point in the market right here, but does not close. So we say, let's say we have 30 seconds left of the candle, but we didn't get a candle close, and then we end up coming back down. This is what creates this wick. So this is the upper wick. Again, we don't necessarily know if this is a bullish candle or a bearish candle until the candle closes. And then of course, at the end of the 1 minute, we have the candle close. And this is where we see if we create a bullish candle or a bearish candle. A bearish candle will always have the open at the top and the close at the bottom. This is the body of the candle where you can obviously see the color. The wick, again, is where the price action has went to, but not closed there, coming back up. And that is how you're going to identify a candlestick. Very important, but what you need to make sure you understand is the candle open and the candle close. So the candle open of a bearish candle will always be at the top, and a candle close will always be at the bottom of a bearish candle, and the opposite for a bullish candle, okay? This is very, very relevant in the future. Another thing that is extremely important that people don't take into consideration enough. What times of the day do you need to trade, okay? You can trade from 9:30 till 11 a.m. This is New York time. This is the best time to trade in the day. There's also two other times that you can trade. That is from 2 p.m. to 4 p.m. New York time, or from 11 a.m. to 12 p.m. New York time, okay? These three times are the best times to trade. Ideally, you want to be trading from 9:30 till 11 a.m. The second best is 2 till 4. And then 11 to 12 is good, but that's for a bit more advanced traders in my opinion. So if you can, stick to 9:30 to 11 a.m. Most of the time, traders are trading all sessions. It's just, when I first started to trade, I would trade every single minute of every single day, and it's just not how you could become profitable. You want to wait for the high volume, leading to the best opportunities to enter into the market, which has the most liquidity, okay? Now, let's start with the actual strategy. So you know what a candle is? First of all, before we talk about the... oh, sorry, my bad. Let's go back there. Yeah, so you know what a candle is. So let's go straight into the daily bias. And to find the daily bias, I'm actually going to jump into the chart example. And I'm going to show you a live example of what on earth, how to find your daily bias. So let's use today. This is a live market. First of all, what is a fair value gap? Because you need to know what a fair value gap is. A fair value gap is simply when you have three candles and they wick, or the body of the first and the third candle don't touch, connect, or overlap, okay? I'm keeping it simple. That's what a fair value gap is. For example, right here, 1, 2, 3, three candles, 1, 2, 3, the first candle here and the third candle here don't touch, connect, or overlap. This is our fair value gap. It's a bearish fair value gap because candle number 2 is bearish. Simple as that. Here is an example of a bullish fair value gap. 1 candle, 2 candle, 3 candles. The first candle and the third candle don't touch, connect, or overlap. It can be the wick, it can be the body. Simple, okay? We're not wasting time around here. How do you find your daily bias? The way that you're going to find your daily bias is by looking for fair value gaps that have been disrespected or that have been respected. Okay, it is as simple as that. So let's take this day in, for example. So let's say we're looking at the charts on Wednesday the 20th of August. How are we going to find our bias? First of all, you want to start identifying all of the fair value gaps that you can see that are relevant. Now, when I say relevant, that are close and that you're actually going to use. So let's say that this candle has closed. This is a bearish candle, because bearish fair value gap. We have a bullish fair value gap here, and we also have a bullish fair value gap up here. So we have 3 fair value gaps on the chart that are relevant, that are close. Of course, we're going to have fair value gaps down here, but these aren't really that relevant right now because price isn't trading by them. So what would our daily bias be in this scenario? You want to wait for fair value gaps that have been inversed, okay? Inversing a fair value gap simply means having a bearish candle close below a bullish fair value gap or a bullish candle close above a bearish fair value gap. It is as simple as that. When we have a candle close below a bullish fair value gap, for example right here, as you can see, we've had this bearish candle close below this bullish fair value gap. There's two things that price is most likely going to do. Either one, come to the next liquidity draw, or two, tap into an unmitigated fair value gap. So as you can see, with this right here, we've inversed this bullish fair value gap. So now where is price most likely going to go? Price is most likely going to go to the lows, okay, because there is not an unmitigated fair value gap. Therefore, if we're trading this price action, our daily bias, which simply means where we think price action is going to go on the higher time frame, will be a bit more bearish, leaning to you ideally want to take short positions on the lower time frames. Of course, this is the higher time frame, so we're not entering into a trade here. So price might want to easily come up, tap into this bearish fair value gap, and then come down, but we do not care about that. We're mainly looking for the inversions. So let's say that in the next few days we come up and we inverse this bearish fair value gap right here. If we inverse this bearish fair value gap, then the price and my bias would be a bit more bullish, okay? Simple as that. So that is how you're going to find your daily bias. And another thing, if price is at all-time highs, then just be bullish, okay? Don't overcomplicate it. Nobody knows when price action is going to come down. If we're at all-time highs, then be bullish, okay? Liquidity and fair value gaps. We're going to look at the following patterns in the markets. Liquidity sweep. Again, I'm keeping it simple and I'm keeping it fast for you. A liquidity sweep is simply when we have a high or a low in the market, and that high or the low gets taken. That can be with a wick, that can be with a body. That is all a liquidity sweep. Because when you're looking in the markets, there's three main types of liquidity, okay? Let me teach you. There's three main types of draws on liquidity. You have trendline liquidity. Trendline liquidity is simply when you can draw a perfect trend line. So imagine that this is a straight line. You can draw a perfect trend line, and this means that there is lots of sell side liquidity resting below this point in the market, okay? Because liquidity is simply where people's stop losses are resting in the market. So an average trader is waiting for a tap of this trend line and then entering into a long position. They're waiting for a tap, then entering into a long position, waiting for a tap, then entering into a long position. So when price action comes back to this trend line, traders are longing from this point. This means that there is so much liquidity resting below here, price action has a very high chance of taking this liquidity. So let's say, for example, price came up, we got a short position right here. Where would we want to target? We'd want to target all of this sell side liquidity because that's very strong. Okay, that's one draw on liquidity. Another draw on liquidity is swing highs and swing lows. So when you can draw a lower low, a higher high. These are different swing highs and swing lows. Again, this simply means there is lots of buy side liquidity resting above this point, where lots of people's stop losses are resting, and lots of people's stop losses are resting below this sell side liquidity in the market, okay? Let's say we got a long position, let's say price came up and burst this bearish fair value gap. Of course we wouldn't because this is the daily time frame, but where would price most likely want to go? Price would most likely want to go for the buy side liquidity. And then we have my favorite draw on liquidity, and that is equal highs and equal lows. So let's say, for example, that this price action has came to the exact same point in the market more than once. So as you can see, the price has hit this low twice at the exact same point. This means that we have created equal lows. And again, if we got a short position, there's loads and loads and loads of liquidity here. Where is price action most likely going to go? To these equal lows, because they are very strong draw on liquidity. And of course it is the same with equal highs, vice versa. Okay, so that is a quick run through of liquidity, and let me know if you do have any questions below. And an inversion fair value gap, that is simply when we have a fair value gap and the fair value gap has been disrespected by having a bearish candle close below a bullish fair value gap, or a bullish candle close above a bearish fair value gap. I'm not sure what's happened with this image. It is very, very blurry, so we're just going to skip past that. Displacement. What is displacement? Now, this is one of the most underrated things, but what is displacement? Again, I'm keeping it very, very simple for you in this video because that's all trading needs to be. Trading needs to be simple and efficient. Displacement is when we have a fast moving candle in one direction with a strong candle close, so with not a lot of wick. Simple, right? And this in the future, you'll thank me for telling you this and keeping this simple, because this will create so many winning trades for you. It's unreal. So when we get a big candle that moves quickly in one direction, showing that there's a lot of buyers or sellers in control, or showing us that the algorithm wants to go down or wants to go up, okay? It doesn't matter how you think the market moves. As you can see right here, this is an example of a bearish displacement candle. So what you can do to pair this up is, when looking for an entry model, wait for a displacement candle that inverts a fair value gap with a nice break-even point at, let's say, equal highs or equal lows. The win rate on that is absolutely crazy. And here's a nice example of a bearish displacement candle. And also, well, right here, sorry, this is a displacement candle where my mouse is in the middle, also with a bearish fair value gap right above it. So now you know what displacement is, you know how to identify your fair value gap, you know how to identify a fair value gap and an inversion fair value gap, and you need to look for your entry zone. So you need to add and pair all of these together. With liquidity, not only are you going to use liquidity as your target, you're also going to use liquidity as context, okay? So here we have a trade example. As you can see, this blue highlighted zone that you see is a fair value gap that is being respected. So not only do we enter when a bearish fair value gap gets disrespected, we also see the fair value gaps that are being respected or not, because if price action is respecting a fair value gap and getting a bullish candle close outside of a bullish fair value gap, and then we inverse a bearish fair value gap, for example, that fact that we're respecting a bullish fair value gap is giving us extra context for the trades. So right here, and context simply means reasons to enter or not to enter into a trade. So our entry zone, what we're really waiting for is context that could be a liquidity sweep. So again, I told you what liquidity sweep is. As you can see right here, we have this swing low, price action has came down, swept this sell side liquidity, we've created a bearish fair value gap, then we have came back up, we've displaced above this bearish fair value gap, we don't have an unmitigated, or we don't have a fair value gap in the way to the liquidity point, because now we've inversed this bearish fair value gap, price should either come to the next liquidity point or take some sort of liquidity. Because we don't have a unmitigated fair value gap, price should go to the next liquidity point. It is that simple. You need to make sure that you're taking anything above a 1-to-1 risk to reward. It says 1-to-2 here. You need to make sure you take anything above a 1-to-1 risk to reward. Ideally, you do want a 1-to-2 risk to reward or a 1-to-3 risk to reward, but anything more than a 1-to-1 is perfect. What not to do? Don't trade outside of the times that I've told you. There is a reason why we trade these times, so don't be stupid and only trade in these windows. Don't enter without a liquidity sweep or an SMT. I haven't taught you an SMT in this video because that is a bit more of an advanced concept. If you want to learn stuff like this, then all of the links are in my bio. Join my mentorship, join my live trading. It will be the best decision you make. And don't over risk and over leverage, okay? Trade futures. Don't over risk, keep it simple, and you will become profitable. So now let's put this all together and show you a real-time live example of a trade that I actually took this week in the market. So I trade live every single day. Let me find the trades live with you right now. So again, I trade live every single day in my Discord, starting at 9:30 a.m. New York time to 11 a.m. New York time. And this right here is a perfect example of a trade that I took on Thursday the 21st of August. Now, this is the trade that I seen. So again, exactly what I just described to you. What do we have? We have a sweep on sell side liquidity. We have a bearish fair value gap here. Not only do we have a bearish fair value gap right here, we don't have another bearish fair value gap in the way to the next liquidity point. We have a nice liquidity point here. We also have an internal liquidity point here, being an internal swing high. Everything that is inside of the main swing high, so for example, this is our main swing high, this is our main swing low, all of these little points below this are internal liquidity points. This is where you're going to use, where you can take some profits, and also where you're going to move your stop loss to break even. So as you can see, we've came down, swept this sell side liquidity. We have the singular bearish fair value gap. There is no fair value gaps in the way. We have different liquidity points, and it is above a 1-to-1 risk to reward. For this high right here, this is a 1-to-2 risk to reward. You even have this swing high you can target for a 1-to-3 risk to reward. So what are we waiting for? We're waiting for a bullish candle close above this bearish fair value gap. Most traders would enter short positions when we tap into a bearish fair value gap. You've probably been taught that in the past, but don't do this. Wait for this bullish candle close above a bearish fair value gap after a liquidity sweep, nice risk to reward, targeting the highs, and look what happens. We go up and take buy side liquidity. This is what I do every single day, and I do it live. This was a very quick trading course to get you started on how to trade with inversion fair value gaps and liquidity. Don't just take my word for this. Look at the market and do it yourself, and I guarantee if you do it properly, you will start seeing the results. There is no two ways about it. I was in your position a few years ago, and now I'm literally in a penthouse in Dubai living my best life because I decided to take action and actually trade with liquidity and fair value gaps. This trade that you're looking at right here made me over 5 figures, and I was in the trade for 1, 2, 3, around 10 minutes maximum. Okay, you can do the exact same. All of the links are in my bio. Sign up for my mentorship. You will not regret it. Join a group of traders that are all trading the same strategy. If you've made it to the end of this video, because most people wouldn't have already made it to this end of the video, I know that you are a serious trader. So comment below and put a smiley face at the end of your message so I know who the serious traders are. Click the link in the bio. Let's get to work. I look forward to seeing you soon. And I hope you found this video useful, all of this free content. Subscribe to this channel because I'm posting so much free content here. And I will see you all very, very shortly.